5 million euros. That is the maximum fine a national regulator can impose on a crypto firm under MiCA before they move to the nuclear option. The EBA, Europe's top banking regulator, now has the power to withdraw a crypto exchange's license entirely. No license, no business. Game over. But here is what most people miss about MiCA enforcement. The biggest risk to a crypto exchange is not the fine. It is the public ESMA register, the list every institutional client checks before doing business with you. If you work in AML, compliance, or risk management at any institution that touches crypto, or if you are building toward a MiCA license, this episode is the one you cannot skip. Because enforcement is where every gap in your controls becomes a public fact. This is the final episode of the MiCA Deep Dive series. We have covered scope, token classification, CASP authorization, governance, risk-based controls, transaction monitoring, and the stablecoin regime. Now we are closing the loop. What happens when a firm gets it wrong and regulators act? MiCA gives national regulators, called NCAs, or National Competent Authorities, a layered enforcement toolkit. Think of it as a pyramid. At the base are supervisory measures, written warnings, orders to remedy a breach, requirements to submit a remediation plan. Then come financial penalties, then activity restrictions. At the top sits the ultimate sanction, withdrawal of authorization. Let me ask you something directly. If you are a compliance officer or risk manager at a firm operating under MiCA or preparing to apply, have you mapped your controls to the specific enforcement triggers in the regulation? Drop a comment. I want to know where practitioners are in this process. The fine structure under MiCA is worth knowing precisely. For a legal entity, a firm, the maximum administrative fine is 5 million euros, or 3% of total annual turnover, whichever is higher. For serious breaches involving market abuse or operating without authorization, that ceiling rises to 15 million euros, or 15% of turnover. Personal liability matters here too. Under MiCA's sanctions framework, individual managers and directors can be fined up to 700,000 euros for personal misconduct. This is not a theoretical risk. It is the same personal accountability architecture that ESMA's supervisory briefing specifically tells NCAs to apply when they review fit and proper status at license application stage. What actually triggers a license withdrawal? MiCA's Article 64 sets out specific grounds. The NCA can withdraw a CASP's authorization if the firm has not used its license within 12 months. If it has explicitly renounced the license, if it obtained authorization through false statements, if it no longer meets the conditions under which authorization was granted, or, and this is the one that should concern every compliance team, if the firm has seriously or repeatedly breached MiCA. A serious or repeated breach is not defined by a single bad week. Regulators look for patterns. An NCA reviewing a CASP for potential withdrawal will look at whether the firm's AML controls were genuinely non-functional, not just underdocumented, whether the compliance function lacked independence, whether senior management actively disregarded supervisory findings, whether the travel rule was ignored across thousands of transactions, not just a few edge cases. Before a license is withdrawn, a firm gets the right to respond. The NCA must notify the CASP of its intention and give the firm a reasonable opportunity to be heard, to submit evidence, make representations, and challenge the regulator's findings. This is not a formality. Firms that have strong documentation, contemporaneous records of compliance actions taken, and evidence of board engagement with risk findings have a genuine opportunity here. Firms that have ignored supervisory letters and allowed gaps to accumulate do not. Here is the head fake in how firms think about MiCA enforcement. Most compliance teams model the fine as the primary risk. 5 million euros, quantifiable. Insurable in theory, manageable. What they underestimate is the reputational consequence, and specifically the ESMA register. ESMA maintains a public register of all authorized CASPs across the EU. Every institutional counterparty, every bank providing correspondent services, every professional investor, they check this register. A withdrawal notice does not just mean you cannot operate under MiCA. It means every business relationship built on the assumption of your authorization begins to unwind simultaneously. This is the enforcement multiplier that the financial penalty alone does not capture. MiCA's enforcement architecture is explicitly cross-border. When a CASP operates in multiple EU member states under a single passport, which is the whole point of MiCA harmonization, an enforcement action by one NCA triggers notification obligations to all others. ESMA coordinates. and the firm's status becomes visible across the entire EU simultaneously. Let me walk you through a scenario that illustrates how enforcement actually unfolds. A mid-size EU crypto exchange, I will call it TradeFlow EU, received its MiCA license from a Southern European NCA in early 2025. It had roughly 80,000 retail customers, a modest institutional book, and a compliance team of 4 people covering AML, conduct, and market abuse between them. TradeFlow EU's NCA conducted its first on-site supervisory review 9 months after license grant. What the examiners found was not a single catastrophic failure. It was a series of compounding deficiencies. Transaction monitoring alerts had a 90-day average closure time. The travel rule system covered only 70% of transfers. The other 30% involved self-hosted wallets that were being processed with no enhanced due diligence applied. The compliance function reported directly to the CFO, not the board, meaning it had no meaningful independence. The NCA did not immediately move to sanctions. Under MiCA's graduated approach, the first step was a supervisory measure, a formal letter requiring TradeFlow EU to submit a written remediation plan within 60 days. The plan had to address the monitoring gap, the travel rule coverage failure, and the compliance reporting line. The letter also requested board-level acknowledgement and a governance attestation. TradeFlow EU submitted its remediation plan on day 58. The plan was detailed on paper. New monitoring thresholds, a vendor contract for travel rule tooling, a proposal to elevate the compliance function to board reporting, but follow-up review by the NCA 6 months later found that only one of the 3 commitments had been implemented. The monitoring system had been partially reconfigured, but the travel rule gap remained at 22%, and the compliance reporting line had not changed. At this point, the NCA escalated. A formal administrative fine of €2.4 million was issued, below the maximum but calibrated to the firm's annual turnover and the duration of the breach. The fine notice was accompanied by a public statement. Under MiCA, NCAs are required to publish sanctions on their official websites unless doing so would cause disproportionate damage to the financial markets or the firm itself, which is a high bar. Within 48 hours of the NCA's public statement, 3 institutional counterparties that provided banking services to TradeFlow EU placed the firm on internal review. 1 correspondent bank terminated its relationship. 2 B2B clients paused their API connections pending their own due diligence reviews. This is what the fine multiplier looks like in practice. The regulatory action triggers a chain of private commercial consequences that no fine calculation ever captures. Here's the second head fake in this story. TradeFlow EU assumed that paying the fine and continuing remediation would be enough to stabilize its position with the regulator. What its management did not fully appreciate is that MiCA's framework, like most EU financial regulation, uses a pattern threshold. Once a firm has a formal supervisory measure, followed by a fine, followed by continued non-compliance, the conditions for license withdrawal proceedings begin to be met. 12 months after the initial on-site review with the travel rule gap still present, and a third supervisory inspection revealing continued independence failures in the compliance function, the NCA formally notified TradeFlow EU that it was commencing proceedings to withdraw its authorization under Article 64 of MiCA. The firm had 30 days to make representations. TradeFlow EU's legal team submitted a comprehensive representations bundle. They demonstrated that the travel rule system now covered 96% of transfers. They provided evidence that the compliance function had been restructured to report directly to the board. They commissioned an independent audit. But here's what matters about representations in this context. Regulators weigh the credibility and timing of remediation. Evidence of last-minute fixes, undertaken specifically to avoid a withdrawal decision, carries less weight than evidence of sustained, proactive control improvement. The NCA's final decision in the TradeFlow EU scenario was a conditional withdrawal. The firm's license would be suspended for 90 days, with full withdrawal if the remaining compliance gaps were not certified remediated by independent audit within that window. This is a realistic outcome in a graduated enforcement regime. Total withdrawal, particularly of a going concern firm with retail customers, creates its own consumer protection problems, and NCAs are aware of this. The TradeFlow EU scenario is a hypothetical, but it is calibrated to patterns from real pre-MiCA enforcement actions. BaFin in Germany issued public warnings and activity restrictions against unlicensed crypto firms operating under the old KWG regime before MiCA took effect. The AMF in France conducted supervisory reviews and imposed conditions on crypto service providers registering under the PCAN regime. The DNB in the Netherlands used AML enforcement orders against crypto firms failing the travel rule under transitional arrangements. MiCA does not invent these powers, it standardizes and escalates them across the EU. There is a specific enforcement window that every firm operating in the EU crypto market should have in its calendar. The MiCA grandfathering period, which allowed firms already operating in member states to continue under national transitional arrangements, runs until July 2026 at the latest. After that date, any firm providing crypto asset services in the EU without a valid MiCA authorization is operating illegally. No transitional protection, no grace period, direct enforcement exposure. Firms that continue to operate after the grandfathering window closes face the maximum penalty tier. Operating as a CASP without authorization is not treated as a technical breach. It is a fundamental violation. NCAs can issue immediate activity prohibitions, freeze customer accounts pending an orderly wind-down process, and refer cases to criminal prosecutors where the conduct also engages money laundering or fraud offenses. The fine ceiling in this scenario is €15 million or 15% of annual turnover. I want to hear from practitioners on this. If you have worked at a firm that went through a supervisory review, a fine or a license process under MiCA, or a pre-MiCA national regime, what was the control gap that the regulator focused on most heavily? Drop it in the comments. These patterns from the field are exactly what helps the next compliance team build the right controls before the examiner arrives. MiCA enforcement does not exist in isolation. Where a firm's AML failures under AMLR are sufficiently serious, systematic failure to apply customer due diligence, deliberate non-filing of suspicious transaction reports, or complicity in layering schemes, the NCA has an obligation to coordinate with the relevant financial intelligence unit. In serious cases, AMLR creates a pathway from administrative sanction to criminal referral. For individual executives at firms involved in large-scale financial crime facilitation, this means personal criminal liability that no corporate fine can absorb. Enforcement architecture is about to add another tier. AMLA, the EU's new anti-money laundering authority, becomes operational in stages through 2025 and 2026. AMLA will directly supervise certain obliged entities that are classified as high-risk or cross-border systemic, and CASPs are explicitly within scope. What this means is that for the largest crypto firms, enforcement will no longer be a bilateral conversation with a single national authority. It will involve direct EU-level supervision with coordination powers across member states. What does an enforcement-resilient CASP look like? Based on everything we have covered across this series, the core checklist is consistent, a compliance function with genuine board-level reporting independence, transaction monitoring with documented, regularly tested alert thresholds, travel rule coverage that is systematic, not best efforts, STR filing rates that match the risk profile of the customer base and transaction volumes, board minutes that demonstrate active risk oversight, not rubber stamping, and an independent audit cycle that preempts supervisory findings. There is a principle that experienced compliance professionals learn, sometimes through hard experience: if it is not documented, it did not happen. Every risk decision, every control review, every escalation, every board briefing, the documentation is the evidence trail that a regulator reads when your controls are under scrutiny. An NCA conducting an enforcement review will form its initial assessment from your records before it interviews your team. Your records are your first defense. I have built a full MiCA enforcement reference guide covering the Article 64 withdrawal grounds, the fine calculation matrix, the ESMA register mechanics, and a pre-enforcement audit checklist your team can use, and it is available on davincidiligence.com, link in the description. If you prefer audio, the full episode is also on our Spotify podcast, Da Vinci Diligence. This is the kind of material that takes real time to assemble from primary sources, and it is worth bookmarking. ESMA is actively tracking the post-December 2024 implementation period. Its supervisory briefing from late 2024 flagged specific areas where NCAs should apply heightened scrutiny in early authorization decisions: governance adequacy, independence of compliance, adequacy of AML systems, and the quality of risk assessments in CASP application files. These are not random areas. They are exactly the categories where early MiCA-era examination findings have surfaced weakness. One practical reality in MiCA's early enforcement years: NCAs across EU member states do not apply standards with perfect uniformity. Some NCAs, BaFin, DNB, the AMF, have extensive pre-MiCA crypto supervisory experience and well-developed enforcement playbooks. Others are building capability from scratch. This creates a divergence risk, where a firm licensed in a less resource jurisdiction faces lighter near-term scrutiny, but also less regulatory guidance. ESMA's peer review powers exist precisely to close this gap over time. Across this series, we built the complete picture from the ground up. We started with MiCA's big picture architecture, why the EU designed a single cross-border framework to close the AML gap that fragmented national crypto regimes left open. We worked through token classification and the fights firms face getting perimeter decisions right. We covered CASP authorization in detail, what NCAs expect, and what gets an application refused. We analyzed governance and the 3 lines of defense failure modes that cost firms their authorization before they even get to a transaction monitoring discussion. We went deep on customer and product risk, how privacy coins, mixers, and high-risk geographies translate into specific EBA risk factor obligations for CASPs. We walked through the transaction monitoring and travel rule framework, including a chain-hopping scenario that illustrated exactly what a CASP is legally required to detect and report. We covered the stablecoin regime, ARTs and EMTs, and the unlicensed stablecoin scenario that demonstrates what happens when reserve and redemption rules are ignored. And now we have closed with enforcement. The core lesson running through every episode of this series is the same one. MiCA is not a compliance exercise, it is a risk architecture. The regulation exists because fragmented national rules allowed financial crime to exploit regulatory gaps at scale. Every AML control gap, every governance shortcut, every travel rule exception that a CASP builds into its model is not just a technical breach. It is a window that financial criminals will find before a regulator does. The enforcement system exists to close those windows publicly, expensively, and on the record. That is a wrap on the MiCA Deep Dive series. 8 episodes covering every major pillar of the regulation from a practitioner's perspective. If this series has helped you map the regulation to real controls, subscribe. I cover financial crime, regulatory enforcement, and AML investigations every week, and there is a lot more depth on MiCA's implementation as enforcement patterns develop through 2026 and beyond. The full series guide, enforcement checklists, and case notes are on davinsaddiligence.com. Share this with anyone building or reviewing a MiCA compliance program. They will thank you for it.